So now that we have established that market structure is the most important thing ever and it lays the foundation for our mechanical trading strategy, let's go deep dive into market structure, right? But first you have to understand the basics. Now, when you really look at the markets and how it moves, and you think from the first principles, it all comes down to these three ways, right? The market can only move in these three ways, meaning it can either go up or go down or go sideways. That means it cannot go zigzag or whatever that you're thinking of, right? Let's keep things simple, right? Basically, the market can only go up, down, or sideways. And when it goes up, it's not going to go up in a straight line like this, right? That's not how the markets work, right? And when it go down, it's not going to go down in a straight line like this. It's going to go up, pull back a little bit, go up, pull back a little bit, go up, pull back a little bit before going up even further. Why does this happen? Because it's essentially like a car, right? Let's say you are a car and you are going to your destination. At some point of time, you're going to run out of fuel. And then you need to stop at a gas station to get more fuel. That's essentially the same thing as the market, right? So the buyers, when they push the price up, at some point of time, there's not going to be enough buyer to continue or rather sustain this upwards momentum. And that is when price will pull back so that, the price of the asset can get to a much more better price at a discount. And then that is when more buyers will jump in and push the price up even further. And then this cycle just repeat over and over again, right? And this is basically just how the market moves, right? If you can really understand this is it. Yeah, this is basically how you make sense of the market. But obviously, like I said, it's not going to be this easy, right? Right now, look at this. This looks like just simple chart diagrams straight out of the textbook. This is like the utopia perfect downtrend, uptrend diagram. And this is just not what the market looks like. Here's what the market actually looks like, right? So this is your expectation and this is your reality. Now, let's seek to understand bullish and bearish market structure even further. First of all, let's look at bullish market structure. So like I said earlier, price will never just go up in a straight line like this, right? It will not just go up like this, like in a rocket style. No, it has to go up, pull back, and go up even further. And this is what we call market structure, right? It's the structure of the market. It's the DNA of the market. It's basically how and why price move, right? So how price works is that price will push up like this, create an impulse, and then start pulling back, and then creates another impulse. Now, when it does this, right, what it does is that it creates this swing high, and then it creates this swing low. Now, this low is only validated after it led to a break of structure, when price actually goes up and break the last swing high. Okay? Let me repeat myself. This is very important. This can only be considered as a valid swing low if it goes up and break the last swing high, creating your break of structure. So what this means is that after price break structure and creates a new high, this high is higher than the previous high. And now we are expecting price to pull back again. Because like I said, you cannot expect price to just continuously going up like this after it just break through the last high, right? At some point of time, it needs to stop and it needs to rest and it needs to pull back so that more buyers will jump in onto this uptrend, this bullish market structure. So that is what we are anticipating, right? So I want you to remember this. Whenever price creates a break of structure, expect a pullback. Anticipate a pullback to happen soon. Right? And a lot of retail traders, what they do is that after price create this break of structure, they continue to buy, right? They continue to buy thinking that this upwards momentum is going to continue forever. And I hate to break it to you, buddy, but eventually price is going to start pulling back, right? And there is nothing wrong with buying after price break structure, but it's just that you can buy at a much better price point, right? At all of these higher lows. So after price creates this break of structure, it forms this new higher high, and then that is when we can anticipate price to pull back. And when pull back, it's going to pull back to create a new low, a new swing low that is higher than the previous swing low. And then it goes up again, creating another break of structure, breaking past the last higher high, and then create another higher high and higher low. So this is basically how an uptrend is formed. An uptrend, a bullish market structure, whatever you like to call it, is formed when price is creating higher highs and higher lows. Higher highs and higher lows. Bullish market structure. Alright, so in a downtrend, it will look like this, right? It's the opposite of an uptrend. So price will goes down, pulls back, create a new high before price goes down, break through the last swing low, creating your bearish break of structure, and then that is when we are anticipate price to start pulling back again, right? And then that is when price start pulling back again, creating another lower high, and then it goes down even further to create another lower low, right? So in a downtrend, price will be making your lower high and lower low. And remember, guys, this lower high can only be considered as a valid lower high after it has led to a break of structure. Okay, after it has led to a break of structure. So the key here is that it needs to break structure, right? In order for this to be considered as a valid high. And in order for this to be considered as a valid low, a valid swing low, it needs to break structure. All right, so get that through your head. So by now you should know that a bullish market structure is price creating higher highs and higher lows, and bearish market structure is where price is creating lower highs and lower lows. Like I said, obviously, this is not what the market will actually look like. Sometimes it will look like that, maybe like 5% of the time, to be completely honest with you, right? Most of the time, the market looks like this, right? It looks like a gigantic mess, right? And when you look at this, right, I always want you to really think about where are the swing highs and where are the swing lows. Because if you can identify that, then you can make sense of the market structure and you can determine whether price is bullish or bearish, right? So let's go through the real graph, right? So over here, this is when price, once again, push up and then pulls back and then push up. After price push up and break through the last high, creating a break of structure, what it did is that it created a minor pullback, okay? A minor pullback, not a significant pullback yet. So after that, price just continue going up even higher before price starts creating a major pullback. Now, once this major pullback happened, this is the last swing high, okay? Not this one right here. It will be this one right here because this is the last high, the highest point before price starts pulling back, okay? And then that is when price starts pulling back and it starts creating this bearish move a little bit, right? Because price is going to turn bearish after, price is going to turn bearish when it's pulling back, right? In order to facilitate that pullback, right? And then that is when price goes down here and then it creates a new higher low right here before price goes up even further. And yeah, eventually break the last swing high, creating a break of structure. So in this case, bear in mind that the higher low will be the low that led to this break of structure. So that means it will not be this one right here, it will not be this one right here, but the lowest point, okay? The lowest point that led to the break of structure. And then that led to price creating another higher high, higher low, and then another higher high, right? And then in a downtrend, this is when price goes down, pull back, goes down, and then starts pulling back heavily. And that is when price creates another lower high before price goes down again and creates another bearish break of structure, right? Breaking past the last lower low, leaving us your lower high right here, the highest point before price goes down and break structure. And then it led to a lower low and lower high again, right? And then just continue going down, continuing this bearish market structure, right? So basically right now, for now, you just need to understand that bullish market structure, higher high, higher low. Bearish market structure, lower high, lower low. And then we are expecting a pullback whenever price break structure. So after price break structure, you are anticipating a pullback. And the pullback means what? That means the market is going to go against the swing trend for a short amount of time in order to facilitate the pullback, right? So in this case, since it's the uptrend, that means the market, when it's pulling back, is going to go into like this minor downtrend, right? To facilitate the pullback before the uptrend continue again and go up even further. Same thing with the downtrend. Since the overall trend is downtrend, right? The market is going to turn bullish for a short amount of time to facilitate the pullback before going down even further, right? So next, let's talk about swing highs and swing lows. How do you determine which one are the valid swing highs and which one are the valid swing lows? Okay, very simple. You always want to look for the highest point the lowest point that creates the break of structure and lead to a swing high, and that will be your swing low in a bullish market structure. And then in a bearish market structure, you always want to look for the swing high, which is the highest point that creates break of structure and lead to a swing low. Let me show you some examples, right, to help you get a better understanding. And then this is when, once again, price push up, pull back, and then goes up like this. All right. So this is obviously a swing high. This is obviously the swing low. And then that is when price goes up, make a minor pullback, and then goes up even further, right? So at this point of time, price has not made a significant pullback yet, right? It has not made a significant pullback to create a new swing low yet. So we still wait. We wait until price starts giving us a significant pullback like this, right? Price goes bearish to facilitate that pullback, right? And goes all the way down here. Now, after this, look at what happened next. Price reverse and goes up, and then led to a break of structural. So you just need to identify the lowest point that creates this break of structure that led to this swing high being broken, right? And if you look at the lowest point, it will not be this one right here because there's a lower point, and it's not this one as well because there is an even lower point, and it will be this one right here. This will be the lowest point that actually led to this swing high being broken, right? And then led to a new high being created right here. So this is your swing low. Okay, so if you need help when it comes to identifying this, right, just use a box tool on TradingView, right? Just click right here, box tool. You just mark up the higher high, right? The one that just got broken. Drag it out like this, and then pull all the way down to the lowest point, okay? The lowest point of price, and it'll be this one right here. So there you have it. You will be able to find your higher low, your swing low right there. And then that is when price goes up even further, right? Creates a new higher high, and then starts pulling back, pulls back, and create another lower high, right? This is to facilitate the pullback, right? It's gonna turn bearish to facilitate the pullback before price goes down even lower, creating a new swing low before price goes up and breaks structural. So same thing. At this point of time, you're asking yourself, okay, since price just broke this last swing high, what is the lowest point that price went to that led to this break of structure? So you can use this box tool method, right? Drag it out and go all the way down to the lowest point, and you will see it's this one right here. This will be the swing low. That means you must go all the way down to the lowest point, not this one right here, guys. The lowest point that led to the break of structure. So that is how you're identifying your swing low and swing high in a bullish market structure. Now, in a bearish market structure, it's pretty much the same thing, right? Price goes down, led to a break of structure, and then it starts pulling back, right? We are anticipating the pullback. And then once price starts pulling back, pulls back all the way up here before price goes down even further. And then price goes down even further, break through the last low, right? Break through the last low, creating a bearish break of structure. So at this point of time, you're asking yourself, what is the highest point that created this break of structure and led to another swing low being formed right here, right? That led to price breaking past this last low, right? So you can use the box method. This time, drag up. Find the highest point that led to this break of structure, and you'll be this one right here. Right? Bear in mind, it will not be this one right here because there's a higher point. It will not be this one because there's even higher point, and it'll be this one right here. So this is the highest point that price went to before it led to a break of structure. Right? So on and so forth. Same thing right here. This is the highest point before it led to a break of structure. Now, why is it so important for you to actually understand this valid swing highs and swing lows? Because more often than not, I found that most traders, when they're just starting out, they end up marking the wrong swing lows and the wrong swing highs. Instead of marking this low right here, they think that this is the swing low, right? And if you mark this as a swing low, it's invalid. Because what happens next is that later on you will learn about market shift, which means after price break through the swing low, right, that means price is going to reverse to becoming a downtrend in an uptrend like this. So if you mark this as a valid swing low right here, now if price goes down and break past this supposedly swing low that you have marked up, you're gonna think that price is gonna reverse, when in reality it is just pulling back, right, so that it can go up even higher. And it's all because you did not identify your swing low properly, right? So please make sure you really try and get this through your head, right? Mark the lowest point, that is the swing low, and the highest point is the swing high. Okay, and also bear in mind that these lows and these highs, they'll be somewhat protected, right? Which means in order for price to actually continue this uptrend, right, price cannot breach this higher low, right? So if price goes all the way down here and it breaches this higher low, most likely this uptrend, this bullish market structure is compromised and it's going to turn bearish soon, right? Like I said, don't worry about this because we are going to learn about this later. For now, just know that it's important for you to identify the correct swing high and the correct swing lows. Now, let's talk about swing range. Now, swing range is basically the range between your swing high and your swing low. Now that you have learned how to identify your swing high and how to identify your swing low, it's time to understand how to identify your swing range. And your swing range is basically the area that is in between your swing high and swing low. As simple as that. No need to complicate things whatsoever here. Right? So in this case, we have your swing low right here, right? Which we have validated, right? This swing low is the lowest point that led to this break of structure and created this new high right there. So this is the swing low. And then you must ask yourself, where is the swing high? The swing high is the highest point before price starts pulling back, and it will be this point right here, right? So this is a swing high, and then this is a swing low. Now, this is basically your swing range, right? After you marked up your swing high and swing low, this entire range right here will be your swing range. And bear in mind, this is the range that we want to be focusing on. That means we will not be giving a shit about what price is doing all the way back like years ago, weeks ago. No, you want to focus on what price is doing within the swing range itself, right? What price is doing right now, right? And then based on this, you must understand that as long as price respect this swing range, no matter how low it goes, as long as it does not break past this swing low, it is still considered as an uptrend. It is still considered as a bullish market structure. Like, so what this means is that price can, after creating this break of structure, we are expecting, or rather anticipating, price to start pulling back, right? So that is when price starts pulling back. Okay, it starts pulling back, goes down, pulls back. That means it can go all the way down here, and it's still counted as an uptrend, right? And because this is still essentially a pullback, as long as it's still within the swing range, right? Eventually, if price breaks out of the swing range, that is when we have a problem. That is when price could potentially reverse to becoming a downtrend, right? So for now, you can see price just keep on pulling back and respect this swing range, right? Come back all the way down to this lower low before going up even further like this. This means this is a continuation and price is just going to continue going up, right? This bullish market structure is just going to continue, right? So in the downtrend, same thing, right? Your swing range will be the swing high and your swing low, and that will be the range between the swing high and the swing low. Is pretty much the same thing, right? So in this case, you can see this is the lower high and then this is the lower low. This means that price can pull back after this break of structure. It can pull all the way up here, right? And it's still considered as a bearish market structure unless price break through this last swing high, right? Then there could potentially be a reversal. So yeah, price can most likely come all the way up here, and then it can still go down and create another bearish break of structure and continue this lower high, lower low dynamic, continuing this bearish market structure. All right. So yeah, please get this through your head, guys. This is very important. Like I said, this is the basics. This is the foundation. And bear in mind that within this swing range itself, right, you will notice that there is also your internal structure, because this is your swing structure, right? Your swing high, swing low, this is your swing structure. And within this swing structure, there is minor market structure being formed, internal market structure being formed. Like example, in this case right here, price goes down, create a lower high, lower low, lower high, and then another low right here. So in this case, this is not part of the swing range because this is just what price is doing within the swing range, right? I mean, this is not a swing high or this is not a swing low, right? Because we have identified that this is a swing high, right? And this is the swing low. So this is not counted as a swing high and this is not counted as a swing low. In that case, this will be your internal low and this is your internal swing high. So internal swing high, internal swing low, right? And this is basically your internal structure, right? Everything that is contained between this swing highs and this swing lows, this is your internal structure, right? Same thing right here. This is your internal structure. For now, don't worry about this yet. Like I said, focus on mastering the boring fundamentals, right? Focus on building that foundation, getting the basics right before we can even talk about internal structure, right? Last but not least, before we wrap up these basics of market structure course, I want to actually go through your strong and weak highs and lows. So earlier on, we talked about how to identify valid lows and valid highs. And it's actually leading to this part right here. This is where we can learn where exactly to enter, right? I want you to keep things very simple once again, right? When it comes to bullish market structure, there will be strong lows and there will be weak highs. When it comes to bearish market structure, there will be weak lows and strong highs. Let me explain what I mean when I say weak or strong, right? Because how do you really define what is weak, what is strong? So in a bullish market structure, price goes up and then it pulls back. And then it goes up and it creates this break of structure, right? When it creates this break of structure, this is basically price breaking past the last swing high, right? Which tell us that this high is weak. Okay, it is a weak high and it can be broken. And when it creates this break of structure, this tells us that this low is strong, right? This strong low is formed after this break of structure happened. This means that the buyers pretty much overpowered the sellers and pushed price up and reached the last high. So this is how your weak high, the term weak high is formed, and strong low is formed, right? So in the uptrend, the lows are strong because price is just creating that higher lows, right? And it's just respecting and it's just going up like this and just continuously breaking past the last high, right? Just breaking past the last high. So weak highs, strong lows. Okay, and same thing right here, right? In this case right here, price goes up, create a high, pulls back, and it led to a strong low breaking past the last weak high, and then it starts pulling back, creates another high, right? And then starts pulling back once again, and then it creates another strong low before price create the break of structure, right? Breaking past the weak high. So in this case, right, I want you to take into account this tip that I have for you guys to really keep things simple. We want to trade from strong structure, trade away from strong structure, and we want to target weak structure. This means in a bullish market structure like this, we want to trade from these strong lows. That means we want to enter for a buy on these strong lows right there. And then when we enter for a buy right there, where should we target? We want to target the weak highs, right? We want to target right here. So if I enter for a buy right here, I'm going to be targeting this area. If I enter for a buy right here, I'm going to be targeting this area. Okay, same thing right here, right? I'm trading from strong structure. I'm entering for a buy here. I'm entering for a buy here. I'm entering for a buy here at all these strong lows. And then I'm going to be targeting these weak highs right there. So in a bearish market structure, right, you pretty much once again be the opposite. So this is when price goes down, right, pulls back and goes down and led to a break of structure. Now in this case, it's the opposite. This case, the highs are strong, right? Because it's the highs that actually led to a break of structure and led to price breaking the last low. So these are weak lows and these are strong highs. Okay, so continue creating your strong highs, weak lows, strong high, weak lows, right? Creating that bearish break of structure, right? Same thing right here. So in this case, in this bearish scenario, using this principle where we want to trade from strong structure and target weak structure, that means we want to enter for a sell at these strong highs, right? We enter for a sell here at this strong high, enter for a sell here at this strong high, enter for a sell here at this strong high, and target where? Our weak lows that we have right here. Okay, so in this case right here, there's a low being formed, there's a high right here, right? This is a strong high, right? So if I enter for a sell right there, I'm going to be getting out right here at these weak lows, right? And same thing right here, right? If I'm entering for a sell right here, I can easily get out at these weak lows. Right, this is basically the principle. Now, for now, I don't want you guys to worry about this too much, right? I don't want you guys to worry about where to enter and where to exit for the trade yet. Like I said, focus on the foundation. Focus on really making sure that you master all of these basics of market structure before we move on to bigger things, right? So just to give you a quick recap, in an uptrend, price will be creating your higher highs and higher lows, right? And when it creates higher highs and higher lows like this, it's going to let this higher low is going to lead to a break of structure, right? Where price break through the last swing high. That is why price is able to create these higher highs and higher lows, because it's continuously going up, right? And just breaking structure. And then there is your strong low being formed in a bullish market structure, and then there is your weak highs, right? Strong low, weak highs, and we want to trade from these strong lows and we want to target these weak highs. And then we also talk about your swing structure, right? And your swing range. So swing high, swing low, this will be your swing range, right? Swing high, swing low, this will be your swing range. And then last but not least, we also talk about how there is three types of trend, right? Your uptrend, downtrend, and consolidation. And you always want to just be asking yourself, is the market going up, down, or sideways? And then based on that, you can trade accordingly, right? Example, we have determined price is uptrend, then we can look for buys right here, right? And then if we have determined price is downtrend, we can look for sells right here at all of these strong highs, right? So yeah, basically, like I said, the thing about this basics of market structure is that you guys must really understand this, because this is pretty much what forms the market. This is the DNA before of price, right? So if you can really understand this, then you can really make sense of what the market is doing, what is the trend right now, who is in control of price, and then you can trade accordingly and make sure that you are on the right side of the market, right? So yeah, go and try to really make sense of this, right? Rewatch this lesson if you need.